I make a quick video. Been getting asked a lot of questions, about, okay, Terry, cool. Thanks for the information. This is good information. I'm interested in investing. I'm going to open up a brokerage account with TD Ameritrade or E-Trade or Robinhood. But, in the meantime, how can I learn more about stocks? And one thing you need to do is, kind of know the fundamentals. So basically, here's some basic terminology. Every stock has a stock symbol. For example, like Google is GOOG. You need to know the stock symbol to do some basic research to see, how much the stock is trading for, some other general information. So one thing I like to do is, it's probably better, things out here, but I just go to Yahoo Finance. If you don't know the stock symbol, sometimes you could just type in the company name. So for today, we're just going to use Target. So Target stock symbol, as you've seen, was TGT right here, TGT. So let's just look at this information. So basically, what this is saying is, if you want to purchase one, share of stock in Target, you need $124.76. Because on Friday, when the stock market closed, that's pretty much where it closed at. So this minus 1.31 is basically saying, on Friday, the stock value went down $1.31, and that's 1% of of his stock price when it closed the previous day. So basically, their stock went down 1% on Friday, basically. So what is his previous close? So on Thursday or the day before, you know, Target closed at $126.07. But then the open is, obviously the next day. So on Friday, it opened at 124.66. So basically, it went down. So if you've been doing some research on the stock and it went down, you might want to buy at that price because, if it was at 126 and it's at 124, chances are it might hit 126 again. You never know. So what is the bid and the ask? So basically, those two kind of go hand in hand. So basically, the stock market opens at 8 a.m. Central, and it closes at what 3:30 p.m. Central. So during this trading day, during Friday, those who were trying to buy the stock, the highest price they was willing to pay for the stock at that moment was $124.63. That's the highest. It's probably some lower bids, but that's the highest. So if the bids is, what they're offering, what's the ask? Well, those people who were trying to sell, their stock at that time, the lowest price they was willing to accept was $124.80. There was probably some higher ones, but the lowest that they was willing to accept is $124.80. So you can see there's a difference of like 17 cents between the bid and the ask. And so sometimes you'll see, what they refer to as the bid and ask spread. That's what that is. The difference between the bid and the ask. What somebody's willing to pay was versus what somebody's willing to sell it. So the days range, during Friday's session, you can look at this chart. The lowest the stock was trading for during Friday's trading session was $123.93. So if you look at this chart, it's probably somewhere right around here. So around 11:14 a.m., it's reached its lowest value during the day. And at some point during Friday, it got up to $125.53. So right around here, right around almost 12:50 p.m. So, I mean, this is kind of, if you do research on stocks, this is good information because, you can see it opened at 124, but at one point it was as low as 123, and at one point it was at highs as 125, but it closed at 124. So what does that tell you? Some people do swing trading and some people do shorting the stock. So the swing trading is, okay, if you bought it, let's say at 123.93 today, and 2 days later it go up to 128, you just sell it. You made a profit, whatever gain that is. If you would have bought, I don't know, yesterday at 123 and you sold at 125, that's like a 2% gain. And you say, well, 2% gain, that's like nothing. That's what banks pay, annually, and you just made a 2% gain, within a matter of moments. And think about it. If you do that every day, or if you do that multiple times a day, it adds up. Or, what's 2% on $1 million? That's a lot of money. What is that, like 20 grand? So think about that. And then when they short, basically what they're saying is, basically they know a stock is going to go up in a day, but before it closes, it's going to go down. So basically, say they'll sell it to you for 125 because they already made an arrangement to buy it at 123, and they just keep the difference. Hey, buy this for $100, knowing that they already have an arrangement to buy it for $90, and they just keep the $10. That's how that works. That's how they short. So the 52-week range, that's basically saying within the last 52 weeks, the lowest price was $66 and the highest price was $130. So if you bought at 66, you sold at 130, you double your money. You can kind of look at these charts and see it too. Like, at one point it was pretty, 66, and at one point it got to like 130. So somewhere in here it's probably like 130. Oh, let's just look at the 5 year. So basically, that's just you can kind of look at the history. So like I said, let's look at the 5 day. Within the last 5 days, it's been declining. Within the last month, it goes down and goes up, and goes down and goes up, and goes down and goes up. So if you buy during these declines and sell when it rises, you make some money. But you kind of know what you're doing. Same thing. Let's look at the last 6 months. Yep, it was down. Well, not really down, but it was selling at 80, and then it was at 100, and now it's at like 130. So you can see it just keeps changing or pretty much rising over time. Even if you look at the 1 year, which is pretty much here, it's pretty much double. So now let's look at the volume and the average volume. So the volume is basically saying, during Friday, there were 5 million transactions, 5 million transactions buying and selling of this stock. But the average daily volume is 4.7. So this is important because, people ask, well, if I buy this stock, how do I know if I can sell it? If you look at the average volume, I'm pretty sure if you bought this stock, you could sell it because yeah, 4.7 million transactions. This stock sells 4.7 million times per day. We're buying and selling. But if you look into a stock and its average volume is like 10,000, that that's basically saying like if the stock declines 30% that day, you probably can't sell it because there's not that many transactions or many people buying and selling that stock per day. So now this market cap. That's basically, some, investors use that to see if they should invest in a company, pretty much the risk. So the larger the cap, the bigger the company is. So Target is a $63 billion dollar market cap. So what does that mean? Small caps are usually 200 million to 2 billion. Mid are like 2 billion to 10 billion. Large are 10 billion to like 200 or 300 billion. Anything over 300 billion is probably like a giga cap. And basically, that's saying like, you know, what kind of risk? The larger the company, usually the less risk. Like Target, Walmart, those are pretty solid companies. It's pretty safe to invest in. And also, it's a formula to determine this. So they use pretty much formula to determine the market cap is the current um, stock price times the amount of outstanding shares. So, well, where do you find how many shares does this company have? So let's just look at statistics. You can find the shares. So basically, to calculate the market cap, you take the share price times the amount of outstanding shares. So I know that the current price right now is 176. How many outstanding shares do they have? Where is it at? Oops, shares outstanding. It is right here. They have 506 million. So basically, 506 million times what, 74? Yeah, 63. Yep, 63.22. Yep, that's their market size cap. All right. So that just give you a good indication, like, yeah, how big the company is, what kind of risk you taking. So next is the beta. So the general rule of thumb is anything less than 1 is good. So this is basic saying how volatile is this stock in relation to the S&P 500. So the S&P, the market as a whole went down 0.71% on Friday, probably because of the Iran situation, but who knows. So the market as a whole went down. Target went down as well, like, minus 1%. So if this stock was real volatile, this number would be a lot higher, basically saying, imagine if the S&P went down 0.7% and Target went down 30%. Basically right then and there, you lost 30% of your money. So that's a volatile stock. It swings, volatile swings. But just like it goes down 30%, it could go up 30%. So great opportunity if you know what you're doing to make some money. PE ratio and EPS. Like what is the EPS? The PE ratio is the price per earnings. And the earnings is pretty much right here, the earnings per share. So what is the earnings per share? So for every $124, which is the current stock price, they're gonna earn $6.25. Some companies have a negative, which means they ain't making no money yet. So some people use this to determine if they should pretty much buy, invest in the company because good earnings per share means they making money. Anytime they making money, that's good. And the PE ratio is the price to earnings. So the current price versus the earnings. So that's also a formula. So you could take the current stock price, which is 124.76, and divide it by the earnings, and you'll get, if I know what I'm doing, 19.96. And that's basically saying, like, even though they earn $6 per stock, they're trading at 20 times that value. So that's why it's 124. You use this number, like, look at some of their competitors. If um if their number is higher than some of their competitors, sometimes that's a good thing. It just depends on how much money it takes to earn a 625. Let's say I could take $100,000 and make 625, but you could take 10,000 and make 625. Then hey, probably want to go with the person who could take $10,000 and earn $6 on it. And so the earnings date is basically when they're going to release their quarterly earnings report. All companies release quarterly earnings reports. That's what investors are waiting for. So let's say, during this time frame when they release it, if the earnings per share goes up, let's say when they release it during this time frame, it goes from 625 to 650, more than likely the stock is going to go up. If it goes from 625 to 6, then they're not making as much money or much profit, then the stock more than likely is going to go down. So that's why everybody waits for the earnings report. For dividend and yield, basically, when a company gets so big, they run out of ways to generate revenue. So, they've done all the, I don't know, expansions, they've acquired companies, they've done mergers, everything. And so what they do to keep investors investing or keep from selling their stock is they say basically we're going to see dividend checks. Dividend checks is basically we paying you a portion of our profits. So basically they're paying 2% of their profits to some of their shareholders. So basically this number right here, for every share that you own, they're going to pay you $2.64. So even though this is a large amount, let's say you own 100,000 shares of their company, 100,000. They're going to pay you $2.64 for every share that you own. So they're going to send you a $264,000 check at the end of the year. But they pay it out quarterly. So every quarter you'll receive a check for 66,000. So the cool thing about that is what some of these like Warren Buffett and them do. They keep their money invested in the company and they just live off the dividend checks. To I don't know, to have 100,000 shares is a lot of money. You probably need, what is this, 100,000 times 1.124. Yeah, you need like $12 million. But you know, Warren Buffett had $12 million. So and the best thing about these dividend checks is you can either live off of it or you can say, you know what, don't send me a check. I want to drip. Like, what's the drip? It's a direct reinvestment. So basically, take the check you're gonna send me and reinvest it and buy me more shares of your company so I can increase the equity that I have in your company. And this ex dividend date is basically saying, you need to own shares of Target by this date to receive the dividend check. So November 2019, if you didn't earn shares, you didn't get a check. If you purchase shares after that date, you gotta wait to the next dividend payment check. If you purchased shares before and you held on to them, yeah, you got your check. So and the 1 year target estimate is basically saying, um, in 1 year, the analyst thinks it's going to go from 124 to 136. So if you buy 124 and it does reach 136 in a year, hey, you made 9% on your return on your investment. I kind of look at this number because sometimes I see a company trading at 25 and the 1 year target estimate is one like 50. I know it's a chance for me to double my money if everything goes right within a year. Sometimes it don't even take a year depending on the news. So anyway, that's just like some of the basic fundamentals. Check it out. If you got any questions, just ask me.